Good morning, everybody. Thank you so much for joining us for business development. We're very lucky to have all of you here. Our sponsors today are Chicago Title with Jill Bright and Allie Flath. And we have a very nice speaker with us today. His name's John Beck. And Allie, do you want to take it away?
Yep, I will introduce John. John, thank you, John, for being here first and foremost. John is the co-owner of Abold and Back CPAs. He actually partnered with them partnered with Abold about 3 years ago, but he has been a CPA for over 40 years. I asked him a little bit about his background in real estate and understanding that area, because he does do my accounting and taxes and stuff. But he is a national home building partner of KPMG. His clients include Monterey Homes, Jackson Properties, Del Webb, Mary Kay Homes, and Ashton Woods. He was an owner of I believe a home building company. Is that right, John? In the early 2000s, and he's got 30 plus real estate agent tax clients currently on his books. So he's definitely schooled in what you guys do and what the ideal filing situations look like for where you guys are all at. So I sent him a couple of questions from Greg as far as what he had heard from you guys. So John's going to run through some of the details of those questions and what you guys need to know in regards to your businesses and what that should look like. John, welcome and take it away.
Perfect, thank you. Yeah, I've got the list of questions. So what I'd like to do is kind of keep this free flowing. So if anybody has any questions, just jump in. Because
do you want me? I'll just control the chat. Is that okay? If you guys have questions, throw it in the chat, and then I'll ask John periodically as they come up.
Sounds good to me.
Perfect. Thank you.
Since I'm low tech, I'll leave you in charge. So I'll go through the questions that Allie sent over, and then build in a little bit more discussion. But basically, what I'm looking at is ways to help minimize your tax burden as agents, and to be in a position to substantiate anything that you've done. So should you get any kind of inquiry from the IRS, which would be basically one of their audits, then you'll be prepared to defend it. And just along those lines, there are 3 kinds of audits that you could be subject to. The most common one is called a correspondence audit. And that is when the IRS sends you a letter. Very typical, very common. We see it all the time. And they just ask about 1 or 2 items. What about this? What about that? We want more information on such and such. And you can usually deal with that strictly by going back and forth with letters or faxes. The second type of audit is a desk audit, they call it, where they ask you to come in. That's pretty rare in this COVID environment. But they ask you to come in with your books and records in detail, and you sit at the IRS examiner's desk, literally, and go through everything. And then the one you don't want, the worst one, is the field audit. And that's where they come knocking when they visit you or your place of business or your home. And those are very invasive, very, very, very time consuming, and usually extremely stressful. So what we want to do is keep you from having to deal with any of those. And the best way to do that is avoid red flags. And red flags are all over the place, but some of the more common ones in your world are going to be if you file a Schedule C on your personal income tax return. If you show a loss on your Schedule C, that's a big red flag. And if you are an S Corp, which we'll get into in a little bit, if you don't take a salary or you have losses, that is also a big red flag for the IRS. So those things are should be in your mind when you're thinking about what you want to do and how you're handling information. But with that in mind, it doesn't mean you can't do it. It just means you have to do it smart. So the first question I had is benefits of a PC, PLLC, or S Corp. Typically, what I see is S Corps. And let's go through those briefly. there are different levels of reporting and the entity which reports. Schedule C I mentioned earlier, which is on your personal tax return. It is literally after Schedule B and before Schedule D in your tax return. And it's self-employment tax. That's where you put your earnings, your costs, and off you go. And that's the one of the red, it's pretty closely looked at schedule. The second thing you can do is form a company. And if you're a single member and you have a company, that's going to go on Schedule C because the IRS considers that a disregarded entity. So a single member LLC, for instance, that's just a Schedule C item. On Schedule C, you'll simply put your tax ID number instead of your Social Security number. But you can be a single member LLC and become an S Corp. And an S Corp, we've all heard about, and it's kind of misunderstood, frankly. But S Corp is not a legal entity. The legal entity is the LLC that you form in the state of Arizona with the Arizona Corporation Commission. S Corp is an election that you make with the IRS, and it is simply, it's called an S Corp simply because it was Section S of the IRS code. So there's no magic to the name. It's an S Corp. S Corps provide you can be a single member LLC, and if you file for S Corp status and it's accepted, then you can file a separate S Corp tax return. You don't have to file a Schedule C. And you can be a single member LLC. The S Corp structure is pretty popular because your profits, the bottom line, there's no self-employment tax. Self-employment tax is the IRS version of payroll tax. So since if you're self-employed, you don't pay payroll tax, you're not getting a paycheck, you're not having any withholdings. Well, guess what? You're not paying payroll taxes. So the IRS, many, many years ago, or Congress really, came up with this notion of self-employment tax, which is in lieu of payroll tax. And self-employment tax is about, it changes, about 15%. So it's pretty steep. Well, if you're filing Schedule C, you're going to pay self-employment tax. If you're filing as a partnership, you're going to pay self-employment tax. If you're filing as S Corp, there's no self-employment tax, which thus S Corp become very popular. The only thing you have to do with an S Corp is you do have to take a salary. So it's called a market rate salary, and there's no real definition of it beyond that. So we generally use a rule of thumb, 20% of revenues or income, whichever appears to be the most useful in those cases. So administratively, S Corps, no different than any other company filing, except you do have to take a salary. So you get with Paychex or ADP or whoever you work with to get yourself a W-2. Okay, so and it can get very complicated. There's a whole bunch more to it, but it's important. And typically, the clients I see have formed S Corps. So again, an S Corp, you simply go to the state of Arizona, you get yourself, if you haven't already, your LLC form, and then you file a form 2553 with the IRS requesting S Corp status, and it's almost an automatic that they give it to you. And they have to get back to you in 60 days with a response. So that's the structures. I prefer having clients with S Corps or a multi-member LLC if they want to do that, which is a separate tax return, because it takes it all off of Schedule C. And S Corp filings and multi-member LLC filings are much less scrutinized than Schedule C. So that's one thing to think about. The negatives of each one, I kind of mentioned. Again, the negative of an S Corp is you have to take a paycheck, and people, I've been working on, I've been here since 6 this morning working on returns, and sure enough, I've got an S Corp and the guy didn't take a salary, so there are some hoops I have to jump through to make that acceptable to the IRS. And it is time consuming. legal ramifications, the basic reason people form any type of entity is to put up some wall of protection legally. So if you have an LLC, which limited liability companies are simply a nice formal way of saying partnership. But you do have some level of legal protection by having a separate LLC. Not bulletproof, it's not foolproof. People can still come after you, but it throws up one measure of defense. It also allows you, like I said, to get off the red flag radar of the IRS by having a separate company that files a separate return.
John?
Yep.
ADRE will only allow us to pay the individual, and when our agents are going through, most of the time ADRE will not allow them to do an LLC. It's usually just the PLLC. So is there something that they can do to combine the both of them?
Yeah, PLLC is a form of LLC. So it's a professional limited liability company. Typically, that's what lawyers and CPAs and some medical practitioners form, professional limited liability company, PLLC. That could be an S corp too. Like I said, the legal form is not the concern for S corps. It's just filing the form with the IRS that says I want to become an S corp. You can be a PLLC, you can be an LLC, you can be a corporation and still elect to file as an S corp. So S corps have a pretty broad umbrella for use. Yeah, and I typically get my real estate agent clients, they generally, as I recall, get some income going to their Social Security number and some going to their PLLC, or some of them have LLC. And, that's just, we just have to deal with it.
And most of the time when I see that is when a individual actually forms the PLLC somewhat during the middle of the year, and their accountant asked for that to be completely separate. So one is their PLLC and one is from their Social Security number.
Right. And that's because any separate business has to have a tax ID number, which you get through the IRS. And that's right. That is attached to the PLLC in this case, which can be an S corp, and that's what they file under. So it can be an S corp filing with a PLLC, and then it's the same drill. Your revenue, your expenses, and you have to take a salary. So yeah, there's way too much detail. We could spend hours just going over S corps, but to give you a broad brush, that's kind of what we're talking about. And I can answer detailed questions about it as we go along. But it's something very common these days. Okay, these are all. So most of these questions are about the formation of the companies. Yeah, who's the best person to set it up, an accountant or attorney? That's a good question. Typically, a CPA can set these things up. The forms with the state are pretty straightforward, but nowadays, I don't know if you've tried it recently, but you generally have to have an account with the state of Arizona to form entities. Most attorneys and get my phone. Most attorneys and CPAs can do that. Getting a tax ID number is no problem. Any CPA can do that. The reason some people will use attorneys is if they have a multi-member PLLC, they may want an operating agreement. The state of Arizona has come out, I think it was about 4 years ago, with a law that says if you don't have an operating agreement, you're going to use the one the state has, and it's pretty onerous. So an operating agreement is very, very common with multi-member LLCs, PLLCs, partnerships, that type of thing. And it's basically a contract that tells all the members or partners, owners basically, their rights, what they can and can't do, what the managing member or managing partner responsibilities are, dispute resolution, that whole thing. So if there's a question or a problem, you run and get the operating agreement, and you look at it and say, okay, here's the answer, here's how we're supposed to do it. Typically, attorneys do that. Some CPAs, like me, have about 50 of these operating agreement examples from the old days. And you pull one off the shelf and you kind of tweak it for the current circumstances. But if you are getting in business with other people, I highly recommend you have an operating agreement, frankly, because I can't tell you how many, it's like any partnership you get into is like a marriage. And marriages can end in divorce. And I can tell you, partnership and LLC divorces can get real ugly and disputes get crazy. And then you get attorneys involved and it's way expensive and very unpleasant, especially if you have a bad operating agreement or you have no operating agreement. So if you're getting in business with anybody, get an operating agreement. And there are examples online. Your favorite attorney can help you. And if your CPA has examples, they can show them to you and you can make your own decisions. But I highly recommend that because I can't tell you how disastrous some of these get when there's no operating agreement. And again, with the state now saying you will default to our operating agreement, there's some really onerous things about minority members, payments you have to make to them, rights and privileges that they're forced on you. So you don't want to get into that situation. Okay. Any 100% need to know tax info specifically for real estate agents? Yes. Keep good records. Here's the deal. The best defense you have against an IRS audit or challenge or really legal stuff is having good records. And that can be all of your invoices, all of your checks that you've written, credit cards that you've used. You can put it on an Excel spreadsheet, anything you want, like QuickBooks, whatever. But don't do back of an envelope and or do a shoebox or a file, or just throwing receipts in, and then you make some notes off to the side, and that's your records for the year. You're gonna get in trouble if you do that. It's tempting and it's easy, and it's time consuming. I know, and you don't want to do it. And I get it. Believe me. I can remember years ago, I would have all my receipts for the year and all my information, and I would sit usually around Super Bowl Sunday on the floor with all my stuff spread out, trying to organize it so I could put my taxes together. And I don't encourage that. I recommend against it. And I don't do that anymore. Hopefully you don't do it anymore or do it at all. So record keeping is key to successful defense of a lawsuit, or worse, in my mind, an IRS audit. And we can get into some of the things you can do. Let me give you a rule of thumb. Number one, never, 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 never underreport your income, your earnings, your revenue. Bad idea. If you want to get creative, then work on deductions. We'll talk about that in a little bit. You can be a little aggressive there, but I can tell you, if you try to hide revenue, you're going to be talking to guys with guns and badges. If you are too aggressive on deductions, you're going to get a slap on the wrist and maybe a slap on the face and have to pay some penalties and interest. So always report all your income.
Hey, John.
Yeah.
Question for you. If somebody is having like a hard time kind of keeping things straight and whatnot, have you seen any sort of like monthly bookkeeping helping, like paying for a service like that, where they can literally offload per month to somebody who they just pay a fee to kind of keep track of all of their stuff, even if they are a little bit of a mess on their own?
Yep. There are a number of little bookkeeping firms out there that can help you. We have a bookkeeping office here in our group. There's a really cool program. I don't know the name of it, but it keeps track of mileage. And I've got a couple real estate agents come in with these cool reports, and I'm sorry I don't have the name handy.
I think it's IQ mileage.
Yeah, it's pretty cool. And that's we'll get into mileage in a little bit, but that one looks really good. And frankly, if you're halfway decent at Excel, you can keep all your records. So if you want to hire a bookkeeper to do your monthly books, that's fine. At least you know how you're doing. If you want to do it yourself, that's fine, just organize it.
Do you know what a bookkeeping service would be for something like that, like a cost wise, just to kind of get a rough idea?
Probably it ranges from 50 to a couple $100 a month.
To have the peace of mind that things are together and ready to go when they need to
Give it to
file.
your bookkeeper and say, here it is.
Yeah. I mean, honestly, even the headache of like, I'm W-2'd, like it's like a systematic thing, but still we're delayed. We never get it in on time, right? So I can't even imagine where agents are with everything that they have to keep track of. So even having a bookkeeping service that you guys can just schedule once a month to leverage that, it's not something you guys really need to focus on. Like figure out a system for you, and maybe that is a couple of apps in an Excel spreadsheet. But if it's a bookkeeping service, I mean, I would pay the $50 a month. That's just me.
Well,
Good.
sorry, John, I was going to jump in on that as well. Having a bookkeeping service, it does a couple of different things. It helps you track where your spending's going and what your income is. It'll show you what your return on investment on anything that you're doing for lead generation. And then at the end of the year, your bookkeeper is going to say, here's all the documents, and hand it off to your accountant, and your accountant's going to say, yippee, yahoo. It makes it so much easier for everyone involved. And it just takes a short period to get used to doing that. And you literally scan all of your receipts, you give it to your bookkeeper, and they take care of everything for you.
Yeah, I know in your world, you're chasing leads, you're advertising, you're tied up with all these offers and all that stuff. I get it. And all this keeping receipts is a pain, and something that's kind of an afterthought in many cases, but it is important because you're a business. You're running a business. Remember that. And as a business owner, you're responsible for all the books and records and all the financial data and all the information that needs to be there for whoever wants to see it, whether it's you, most importantly, a bank, if you're trying to get a loan, in a number of circumstances. These SBA loans that came out that were forgiven, if you didn't have good books and records, you're screwed. So then of course IRS, which is the big gorilla out there that nobody wants to have to deal with, including me. So a couple of other things we need to talk about. You guys, you're in the IRS world. Real estate agents are called a specified trade or business because you're a service. So you can get this qualified business income deduction, which is usually 20% of your bottom line, which goes in your tax return. It's limited, and if you make more than $160,000 a year as a single, or 330 roughly as married filing jointly, anything over that, you start to lose that 20% benefit. Under that, you get the full 20% benefit. So if you make, your bottom line is $50,000 for the year after all expenses and all the stuff, theoretically you'll get $10,000 additional deduction as qualified business income deduction on your personal tax return. So it's called QBI. A lot. That's what it means. Qualified business income. You and me, because I'm a service also, are in this specified service business activity. So if you make over those numbers, 330 roughly, if you're married, it starts to go away. But below that, you do get a tax benefit. Again, that comes when you keep good books and records. Now, what are some deductions? I've got 2 pages of deductions that people can use. If you go online, you'll see all kinds of information about real estate agent tax deductions. And you can see some of the more common ones and what you have to do. In each case, let me tell you how we look at, or how you should look at whether something is deductible. And I'll go through the list in a little bit in broad terms. I don't want to go through every line item. Basically, if you spend money to create revenue, So you advertise, you buy a car that is what your clientele will want to see. You have signage out there. You have, you spend money getting someone to run around and do stuff, all these different things. As long as that cost is incurred with the likelihood that it's going to produce revenue, which obviously that's the taxable side, the IRS will be okay with it. They call it the RON rule: reasonable, ordinary, and necessary. RON, reasonable, ordinary, necessary. As long as that is the case, you can most likely deduct that expense. And the list is remarkable. I mean, advertising, accounting, consultation, bookkeeping, bank service charges. And remember, let's go back for just a second. Keep separate records. Keep your personal account separate from your business account. So you should have a separate bank account, credit card, everything for your business. And a separate bank account, credit card, or plural, credit cards and all that for your personal. And don't commingle. Commingling gets you, first of all, it gets to be problematic because you have to figure out what the heck happened for the year when you're doing your books or someone is doing your books. And secondly, the IRS considers that to be a red flag. If they come in an audit and they see you commingling, they're immediately going to assume the worst, and they're going to start disallowing things very, very quickly. So keep separate accounts. So bank service charges and fees, car and truck expenses, we'll talk about those a little bit more. Credit card annual fees, your computer supplies and repairs, depreciation, which we'll get back into when we talk about the cars, dues and subscriptions and fees, your seminars, education, training, conferences, your employee pension and benefit program. So you can, if you're a separate business, have a SEP, basically self-employed IRA, and you can set that up with your favorite investment person. Company activities, equipment, computers, furniture and decor for your office, if you have a separate office. Gifts to business associates up to $25 per person. That's a big sticky point, by the way. These gifts, the rules are $25, but I've never seen that enforced. So if you have a client who bought a big home and you want to thank them and you give them a floral arrangement or something that's $200. I've never seen the IRS disallow it. We just call it client gifts, and as long as you have a receipt for it and it was related to a valid activity, I've never seen a question. So keep track of that stuff. Let's see. Home office expenses. Now those are a little bit trickier. Home office is another red flag. Sorry, you guys are in red flag world, I'm afraid. But a lot of people are. The home office expense, basically, if you not familiar with it, basically it says, okay, if you work from home, which many people do, if you work from home and you have a workspace that is exclusive to your work, in other words, it's a separate room, separate activities, it's not a playroom where the kids are coming in and playing while you're in there screwing around. It's not your office at home where you have all your personal stuff as well. It is literally a separate business. Hopefully a separate phone line. Of course, it's all cell phones now. Separate dedicated fax line, separate dedicated internet stuff, all that. The rule is you take the square footage of that room compared to your house. So if you have a 2,000 square foot residence and you have a 200 square foot office, then that's 10%. Then 10% of your indirect expenses, which would be mortgage payment or rent, insurance, all that stuff, 10% of all that can be deducted as business, as well as direct expenses, which would be if you pay separate utilities for that room, which is unlikely, but it can happen. Separate charges for whatever happens there, then all that direct cost plus 10% of indirect can be deducted. I don't, there's a safe harbor for that. It's 20, it's complicated, but basically it's 1,500 to 2,500 bucks. You just say home office and you can get by with it. Otherwise, you have to go fill out a separate schedule that that will get the results, same results basically. If you have more than 2,500 bucks in home office expenses, you're probably creating red flag world for the IRS. So it's something you might want to look at when you're thinking about it.
So John, when you see that and somebody's using a home office, do you want the PLLC to actually pay the individual for like their mortgage, so that office fee?
No, what I want to see if they have a PLLC is I want to see that expense in their PLLC. I don't want to see it on their personal return, because the PLLC should be paying for that, you know, any bills that come in related to that 200 square foot office space. And frankly, if it's over in the PLLC, or let's call it company return, it's not really looked at that closely. So it's a, you know, what most people do, and my clients do, is they just say, they call it rent, personal rent, and it's usually 2,500. Surprisingly, it's usually 2,500 bucks a year, and then we're done. And we've never had a problem with that.
Okay.
So, obviously insurance that you pay, you guys have insurance, interest on credit cards and loans, internet costs, of course, legal and professional fees. So if you pay a lawyer to get an operating agreement, or you pay a CPA to do your tax return, or any of that stuff, that's all deductible. Licenses, renewal of all your licenses is deductible. Professional journals and publications, maintenance and repairs on your equipment, meals and entertainment. Okay, let's talk about this. This is where you get into a little bit of trouble. The new tax law says entertainment is no longer allowed, no longer deductible. So if you take someone to a Suns game, or a Cardinals game, or to a Phoenix Ballet or something, it's no longer deductible. So what do? We're still entertaining. We're still trying to, you know, befriend these people and let them know we're there, and we're trying to get them to think of us. What we're doing in the CPA world, a lot of us, is we're just calling it marketing or promotion. So don't use the word, when you're doing your summary of what you did for the year, don't use the word entertainment. Get that out of your vernacular. Just call it promotional activity or marketing, and bury it in there. Meals are also a little bit tricky. Meals, you're only allowed to deduct 50%. That's, you don't need to worry about that 50% calculation, because your accountant will do that. Your tax preparer will do that. What you do need to worry about is the substance of the meals. And let me just go back. The reason the meal thing is 50% is because the IRS always assumes you're one of the people eating. And guess what? You eat, and you don't get deduct it all day long. So you're not going to be able to deduct any meals expenses that you have 100%, because you're involved. How do we do any more with that? Well, it has to have a purpose. So it has to have a business purpose. So if you're just taking someone out, you know, you're two couples going to some restaurant to celebrate something, unless it's a client or you can justify it, be careful. The easiest thing to do is just make a quick note: who was involved, what was discussed, and then you have your, if you're assuming it's a credit card payment, you have your business credit card that says where it was and when it was and how much it was. So that's all you need. So meals, entertainment is now out of your vernacular. It's marketing or promotional or something in that realm. And meals, just be sure. An IRS agent told me years ago, when she was beating the holy bejesus out of a flaky client, they were getting beat up on meals. And she said, you know, guys, if you would just take your CPA to these meals, it would all be deductibles, which I guess I found a little humor in that as I was watching this carnage going on, but just document it. And I've not seen the IRS recently beating people up on that very much unless it's a huge number. Do I
Hey,
know
John,
that?
when something like that happens, when they take away a big portion like that and you have to kind of reallocate, is there a reason? Are people just taking advantage of it too much? Do you ever see those things come back? Like, how does that normally?
Knock on wood, I've never seen the IRS, other than this one audit, which was much more comprehensive. That was just one, meals were just one little piece of it. No, unless it's a huge number, it's not a big red flag.
Gotcha.
You know, some people get really carried away. And,
Yeah.
you know, look at it. Here's another one. Professional education. I have quite a few nursing clients, registered nurses and CRNA clients. And it's amazing that they come in with receipts for professional education in Croatia or the Bahamas or Hawaii. Well, guess what? Professional education, as long as it was a real course and it was there, they can deduct it. So some people get really creative with how they run their business. And,
Right.
you know, if it's real obscene, they've taken their whole family, then we'll take maybe 50% of that deduction. But you can get a little creative in this tax world.
I do have a question that came in. So when you say not a huge number, like when people are writing off, you know, what was previously entertainment, what is huge number to you? Or does it just depend on the revenue of the company?
It depends on the revenue of the company, but I think anything over 5,000 is getting to be big.
Okay.
Yep, that's when it gets. If I see a client come in with 10,000 in meals and that kind of stuff, I get worried. That's a pretty steep number. So if it's legit, it's legit, but that gets my attention. So my magic number, and this is my world. This is not the IRS. It's $5,000.
I think I might have 5,000 in Starbucks purchases a year.
Yeah.
Oh goodness.
Remember, it's got to have a business purpose.
Luckily, I'm not.
And if it's meals, it has to involve somebody who you can name on your little receipt. Anyway, so we'll wrap up this little thing. So rental activity, if you rent equipment for some reason, of all things, small tools, subcontractors, if you pay somebody to do work for you, be sure you give them a 1099, and that's deductible. Would
a bookkeeper also be able to do that for you or no?
Yep.
Okay.
Usually
cool.
bookkeepers do a 1099 issued.
Awesome.
Obviously, your telephone, obviously business travel, which is where I was talking about these nurses who go to these exotic places. Yeah, those are that's kind of the bullet point list.
Awesome. Other than the entertainment change, is there any significant changes to how an agent should file or what they should know that has changed in the last year from when they last filed significantly?
No, the entertainment's the biggie. The qualified business income is to your benefit because it allows 20% additional deductions for a qualified business income. The other rules have really not changed significantly. Remember, the IRS is understaffed. Okay, they're not going into the office. So anybody who's tried to contact the IRS has probably been on hold for, I would guess, an hour minimum. So they're looking to do their work by exception. So they get reports that tell them, look at this taxpayer because there's something that stuck out, something out of the ordinary. $20,000 on meals, perhaps, when they only are making $100,000 or something. So the CPAs that do your tax return have reports that show up in their tax prep tools that will say, hey, this number is kind of out of whack with the typical number that we see. So they can tell you, hey, this is, we may want to look at this again because such and such deduction is really high compared to what most people do and what the norm is. Doesn't mean you don't do it. It just means you're careful to look at it and say, well, is this really 100% rock solid, or do we want to pare it back a little bit and, get back into the norm and stay under the radar? But your CPA can do that for you. Real estate agents as a group are not one of the big targets. frankly. I mean, the big targets are pure cash restaurants, obviously, are a big one. Bars, of course. Anything to do with the big new one is anything to do with virtual currency. If you're trading in virtual currencies, the IRS is all over that, and you will be scrutinized, and that type of stuff. So
Yeah.
and high wealth, obviously, people who make millions and millions, they're much more likely to get audited than.
Do you see any more excess liability on the agent side or the real estate agent side when they have more investments, like investment properties or stuff like that?
Yeah. So that's interesting. A real estate agent has investment property, and if they're flipping, that's one thing. If they're renting, that's another thing. The rental activity as a real estate agent, you're a real estate professional. And theoretically, you can have a lot of advantages by having rental properties. In the tax world, if you're just you're a doctor or a lawyer, administrator, nothing to do with real estate, your rental activity is called passive income and passive losses. So the main point in there is the passive losses. You can't take any losses below zero on a rental property if you're not a real estate professional. Real estate professionals, if you have 1, 2, 3, I don't know, number of rental properties, and you have losses in those rental properties, you can take those on your tax return because it's not passive income, it's active income. Because the IRS, well, Congress, with the Tax Reform Act, allowed real estate professionals to get the benefit of losses in rental properties. And the losses in rental properties generally come from depreciation, because you want your rental property to cash flow typically. So that's fine, but then you throw in depreciation depending on the nature of the rental property, and it can throw you into a loss. It's a non-cash loss, but it's a tax loss. And if you're a real estate professional, you can take that as that loss can help reduce your taxes.
So it's not a terrible thing.
Oh God, no.
It's a benefit to having your license and being a real estate professional.
Yeah, yeah. Now go out and find a place. Good luck. I mean, as you all know, it's crazy out there. And I sit here feeling sorry for myself at 6 in the morning or 9 at night, but I know you're in a crazy world too with the way the market is around here. And I have real estate clients that come in and tell me. I mean, they're telling me that you should have seen this one property I put in a bid, and some guy came in and offered a year of free hamburgers along with his offer. I mean,
Oh my goodness.
it's crazy. I'm hearing all kinds of stuff from clients.
I know. That's
So
nuts.
It's out of my. I can't even imagine what it's
Yeah.
like.
It's been a crazy year for sure. Okay, so questions for you. Can you send me that list of that, and then can you also send me the contact for your bookkeeping service too? I already put your information in the chat, so if people want to contact you directly, they can.
Sure.
But I figured if we can send out a couple of extra things. Does anybody have any more questions? I know we're getting down to the end of everything. Greg, do you have any more questions at all? Or do you think any agents, did anything come in before? I know you sent me most of the questions, but I figured some might come up or not. I don't know. I know a couple of people are traveling and driving right now.
Right. I think one of the big ones is it really worth a real estate agent's time to go through it and become a PLLC or an S Corp? Do you think there's really a benefit for them? Because if not, why are there so many people that are doing it?
Yeah, the benefit is you can be more aggressive on your tax deductions if you have a separate company. Otherwise, just put in Schedule C and keep good records and be self-employed, and all is good, except remember also you're paying self-employment tax. So by getting a lot of this work over to, in your case, a PLLC, and making that an S Corp. Remember, S Corp is not a legal entity, it is a tax entity. You will save yourself self-employment tax, and that can be a pretty big number if you're having a good year. So I every one of my real estate agents has a separate desk board. Every one of them. And, you know, they have good years, they have bad years. One of them was in yesterday, and she's having a so-so year, and she expressed the same frustration that you all are dealing with the crazy world out there. So, but I'll tell you, the odds of you being audited are low. But there are red flags. I don't suggest waving red flags, because the IRS can make an example out of you, let alone just making your life miserable. But most importantly, you're out there to make money and to be successful. And to do that, you really need to keep good books and records, not to keep your CPA happy, not to keep the IRS happy, but to keep you in the know as to how you're doing. You could be making $300,000 a year and spending $305,000 a year. You're broke. So I know that's an extreme example, but you need to be you're a business person. So act like a business person. Do your professional duties out there, getting those sales, getting those listings, doing the right thing. But also never forget you're running a business, and you're the first person that needs to know how well that business is doing. So
I love that. And I think that goes into, John, like a lot of agents, you know, I think don't have a far-sighted plan for retirement, and looking at, you know, a business that's in order and how to retire and kind of how to maybe pass along a business to, you know, an understudy or a family member or whatever it is. I think it's really important to have good books in that case as well, when you're looking for the future as far as retiring and maybe getting out of the business. I know there's a lot of agents.
Along those lines, you should talk to your favorite investment person and ask them what kind of plans they have that you can put retirement money into. There's self-employed 401ks, there's SEP IRAs, there's all kinds of profit share, there's all kinds of stuff out there. And your favorite investment person is more than happy to talk to you about all the different plans. I think it's coordinated with your CPA, and like Allie's saying, you just start funding your retirement.
Yep, but you gotta have,
believe me, it does come quickly, folks.
yeah. Well, and you gotta have good books for that stuff. So I think, Mary, you have your hand up. Do you have a question?
I do. John, I'm curious, because of the market, agents have been paying for things like home inspections and home warranties, which I sell. If an agent were to pick up a cost anywhere from $500 to $700 for an inspection or a warranty, is there a write-off opportunity there for them?
Yeah, you paid for it. It helps your business, deduct it. But be sure it's a wise, remember, one trap people fall into is they spend money saying, well, it's tax deductible. Well, remember, you're spending $1 to save 30 cents. So be sure it makes business sense before you do it. Okay. It's like going to Vegas. Vegas, you know, they talk about 98% win. Great slot machines. I'd never ceased to amaze me. I mean, they're telling you folks, 98% is a good score on a test. 98% win means you're losing 2 cents every time you bet $1. So, I mean, think about whether your expenditure makes sense in terms of your business and then in terms of taxes.
Okay, does anybody else have any other questions for John?
I don't think so. Thank you, John, for being here. I appreciate it. I know you're busy.
My pleasure. I hope I wasn't too boring with this darn tax stuff.
No, I need you to get back to my filing, so make sure.
Well, John, I think you brought up some really good information for everybody, especially about the bookkeeping. Unfortunately, a lot of agents are just kind of, let's fly by the seat of my pants and we'll figure it out later. But it really is, you need to know your P&L, your profit and loss. That way you can decide where you need to really invest your money. If it's helping out or if you're losing money on it, it's time to change. So keeping good records is one of the best things that that you can do as a business person.
Yep, I totally agree with that.
All right, well, thank you very much for being here, John. We really do appreciate your time. I know our agents appreciate it as well. Thank you to Allie and Jill for being our hosts today. And if you guys have any other questions, you can reach out to myself or Allie and Jill, and we can help you out on today's subject. Thank you, everybody.
Hey, folks, you've been great.
Thank you. Thanks, John.
Thank you.
Take care.